If you think Netflix is a great buy because of the current issue we're facing now, watch this video before pressing the buy button. Hi guys, this is Dan from the Investment ABC, and in this video I'm discussing whether Netflix is a great buy at current prices or rather a great short. Netflix is currently the #1 streaming service provider in the world with around 183 million subscribers worldwide. It has been one of the best performing stocks in the last decade and gave investors a 100x return on their investment, while bankrupting former giants like Blockbuster. No wonder that investors seem to be bullish on the stock. So let's have a look if Netflix will still bring a smile on the faces of new investors in the coming years by checking the numbers. We can see that Netflix's revenue increased significantly from 2016 to 2019 from 8.8 billion US dollar to roughly 20 billion US dollar in 2019. We can also see that the operating margin also improved from 4% in 2016 to 13% in 2019. The operating margin measures how much profit a company makes on $1 of sales after paying for variable costs of production such as wages and raw materials, but before paying interests or taxes. In the case of Netflix, it is 13 cents profit for every dollar in revenue after paying all variable costs. Netflix's net income increased also significantly over the years from 186 million US dollar in 2016 to almost 1.87 billion US dollar in 2019. Although net income increased significantly, the free cash flow also decreased significantly from negative 1.65 billion in 2016 to negative 3.14 billion in 2019. Free cash flow represents the cash available to creditors and investors in a company after accounting for all operational expenses and investments in capital. In the case of Netflix, the negative free cash flow means that Netflix needs to spend more than the net income to maintain its operations and grow its subscriber base. It had to issue more debt over the years to sustain operations. This is a very crucial point to the valuation of the company. The question is, will Netflix be able to reduce costs and become free cash flow positive in the next few years? And when will that happen if yes? I want to discuss this in the end of this video, so stay tuned. Netflix's current ratio declined from 1.25 in 2016 to 0.9 in 2019. The current ratio is the ratio between current assets and current liabilities and determines the ability of a company to operate in the next 12 months without borrowing more money. A current ratio of 1 means that the current assets are covering the current liabilities. Netflix's subscriber base grew from 89.09 million in 2016 to 167.09 million in 2019. But at the same time, long-term debt grew from 3.3 billion US dollar in 2016 to 14.7 billion in 2019. And only yesterday, Netflix secured another 1 billion in loans from the debt market. Like I said before, Netflix had to invest a lot of money into content and marketing to grow its subscriber base and most likely has to increase debt further until it turns cash flow positive in the future. Netflix recently reported its first quarter earnings results for 2020 and the numbers were very good. Netflix increased its subscriber base from 167.09 million to 182.9 million in just one quarter and also achieved for the first time a positive free cash flow quarter due to curbed spending for content in the current environment. But the CEO also said that it will take a long time to turn fully free cash flow positive. If we compare now Netflix to some of the other FANG stocks, we can see that Netflix's PE ratio is second to Amazon with 87.43. That is a staggering high PE and already anticipates that Netflix will still grow with high double-digit numbers. The other metrics like the price to sales ratio, the price to books ratio, and price earnings to growth ratio are all higher compared to its peers. What is interesting is that Netflix's market cap is almost as high as Disney's, although Disney also increased its subscriber base significantly over the last few months since they launched Disney Plus. If we have a look at both PE ratios, we can see that either Disney's PE ratio is maybe too low or Netflix's PE is too high. We can make an assumption and try to figure out what the fair value might be in 5 years. I'm assuming that Netflix would still grow by 20% over the next 5 years, which would give it a revenue of 40 billion US dollar at that time. Furthermore, I'm assuming operating margins would increase to 15%. I don't think Netflix would achieve a higher operating margin than 15% because they don't have a monopoly anymore like in previous years. Netflix needs to maybe decrease prices at some point in the future and still invest a lot into new original content licensing and marketing. 40 billion in revenue and an operating margin of 15% would give us an operating income of 6 billion US dollars. In the past years, net income was somewhere between 65 to 75% of operating income. If we take the 75%, we would get a net income of 4.2 billion US dollar. If we divide the net income with the number of outstanding shares, we will get an earnings per share of $9.55. I wouldn't give Netflix a PE ratio of 87 anymore in 5 years, but maybe one around 45, which might still be too high in my opinion. Netflix most likely won't be able to grow at today's rate in 5 years. We would get a price of around $429.76, roughly the same price as we have now. Based on the numbers and also the fact that Netflix lost its monopoly status and its negative cash flow, I wouldn't buy Netflix at these prices, to be honest. In my opinion, Netflix will still have negative cash flows for the next couple of years because now with strong competition emerging, they can't cut spending on content or marketing and most likely can't increase its prices like in the past anymore. If we have a look at the chart of Netflix, we can see that Netflix is trading inside this ascending triangle and currently is on the verge of breaking out. If we see weakness in the price action in the next few days, it might be a good time to short Netflix because it is likely that Netflix is touching its trend line one more time before either breaking to the downside or to the upside. The verdict is that Netflix will most likely stay the leader in the streaming service industry for a while before Disney can threaten them with its higher quality content. But in my opinion, long-term Disney has a good shot at dethroning Netflix because of all the blockbuster movies they produce and the strong brands. Furthermore, Disney is producing anyways a lot of movies for the cinema which they just need to upload to Disney Plus. At current price levels, Netflix seems overvalued to me. The price already reflects a lot of growth and the risk for disappointments is just too high compared to the rewards in my opinion. So I will give it a pass here. If you like this video, hit the thumbs up button, share, subscribe and comment your opinion if you think Netflix is overvalued or not. Bye guys and see you in the next one.